Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Finally, it's a Friday, and thank God it's a Friday. Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. Should I say lots to track? Yes, lots to track, but not overnight because US markets were shut. I'm Prashant. With me, my colleagues Nigel and Survi. Guys, hi, morning.
Hi, good morning, folks. Well, it was last Friday when we woke up to the news of all those missiles hitting Iran and Iran then retaliating. From then to now, I don't think we have final answers that this is over, but at least it's contained. And we approach this Friday with hope that at some point it's going to be that trade deal or the nuclear deal or some deal will prevail over the missiles.
Well, I'm quite disappointed, actually. I thought a week later we would have some kind of de-escalation. That's not happened at all, and the fear is it could escalate over the weekend. I think that's the problem point. But our markets actually have been unmoved, at least the headline index.
Absolutely, and they've been flattish. IVs are low, and volatility actually has been very low as well. So almost a boring kind of market, right? Last 3 days or so. But boring is good sometimes. You don't need all the excitement all the time. Some of the time is good, I guess. Well, let's just quickly run you through the top of the mind cues as we sort of kick off this new session. So US equity and bond markets were shut last night. And this is so no action in that sense from US markets, financial markets overall. Now, Israel-Iran conflict top of mind. It's the 8th day now. So the conflict sort of is going on. I want to start with, of course, straight up oil prices, which Brent oil prices hit 79. And then they sort of fell to 77, where they are right now, 77, 77.50, basically in that range. And what caused that was the drop-off, basically, was the White House essentially saying that U.S. President Trump has said that a decision on whether the U.S. joins the fight will come within 2 weeks. So, that's now a new kind of timeline. Within all the timelines, there's another timeline, which is that within 2 weeks, it could come anytime, but 2 weeks is when Trump will make a decision. He also, by the way, Trump also called Iran's interest in diplomatic talks a little too late. I mean, they kind of indicated that they've had approaches from the Iranian side to talk peace and talk negotiations, if Israel stops attacking it. But they said, well, perhaps it's a little too late. Now, in terms of specifics, Israel hit Iran's Arak nuclear facility and a nuclear armament site in the Natanz region. I don't know if you have the graphics on, we should put them up. And Iran, of course, has been launching ballistic and hypersonic missiles, including the Fatah-1 at Israeli targets. This is an indigenous missile which has been developed by Iran. And it kind of takes the war into a new kind of zone. Now, later today, you have the June options expiry in the U.S. Just to sort of look ahead a little bit, it's the largest on record, by the way. This June expiry is the largest on record. Some $6 trillion worth of notional options exposure will expire. Basically, sometimes leads to greater volatility, sometimes a little bit of one-way price action as well, which gets reversed the next day, which is Monday now. Accenture will also report from an Indian IT services perspective. Accenture's reports later tonight during US session will be important from an IT stock perspective as we come back. Not very much to kind of report in terms of levels, etc. They're all, by the way, I could have put yesterday's levels, what I put out yesterday. I mean, they remain exactly same because the Nifty is not moved, absolutely flat. But the pain showed through in mid and small caps. So 1.6% lower on the mid-cap index and almost 2% cut as far as the small-cap index is concerned. And here, there was a fair bit of pain. Actually, market breadth was one-way negative, and we'll talk more about that in a bit from now. So the levels, Nifty, lower bound support is 24,473. The resistance is 24,982, which is the high of the week, I think now. Bank Nifty support stands at 55,149. And then the next one is 54,200. As I said, numbers have not changed. They're not moving averages. And the resistance is 56,067. So that's there. That's the overall picture as far as this Friday is concerned. GIFT Nifty will come up on your screen, and it'll give you a sense of how we are opening 10 points lower. So once again, like what we've seen over the last 3-4 days, not very different. Guys.
Okay, absolutely. Well, in indecision, that's what you have in Asian markets right now. And if you go by US futures are actually slightly lower, down about 0.25% on the benchmark indices out there. But Asian markets kind of all over the place. You've got some red, for instance, on Japan, the Nikkei. Hang Seng's managing a little bit of a green. But let's come to the data points that we've got out of Asia this morning. First, the rate decision from China. The PBOC has left the key rates unchanged, and that was widely expected. So the one-year loan prime rate is at 3%. The five-year loan prime rate remains at 3.5%. So no changes over there. But in Japan, there is slightly worrisome data. You know, inflation in Japan is proving to be very, very sticky. And the core inflation numbers that have come out for the month of May, they're actually higher than estimates as well. Core inflation is at 3.7% in Japan, and that's the highest we've seen since 2023. Japan getting into inflation zone and staying there. And it's also above the print that we had in the previous month. It was 3.5%. Now it's 3.7%. So there's a lot of guesswork on what the BOJ will do, whether the BOJ at some point will have to hike rates, irrespective of the other situations out there. Now, for India, the market has been going through a consolidation patch. At the headline index level, we've actually not moved at all. The Nifty is down 0.2, 0.3% for the week. The issue is the broader market pain. And that's really showing up because if you're looking at the mid-cap index or the small-cap index, then the cut is around 2%. The micro-cap index for the week is down nearly 3%. And yesterday, this was very, very clear. It was apparent. There's a lot of profit-taking going on after what's been a pretty decent rally throughout most of April and May. Let's see at what point this changes. On the flows side, actually, we had buying yesterday on the institutional front, both DIIs and FIIs. There were buyers, about 900 crores from the FIIs. Domestic institutions net bought stocks worth about 600 crores. I'll just quickly come down to some of the local market action in terms of news flow, regulation and stocks. So watch out for a lot of the project financing companies, and many of them are large NBFCs like PFC, REC, HUDCO, IRFC. Also, watch out for large PSU banks, which are into project financing, because we finally have the RBI's final guidelines and rules on project financing. And the good news is that they're not as onerous as what the draft had indicated. For instance, the standard asset provisioning for projects which are under construction, as per the final rules, will be 1%. The draft had proposed 5%, and that's when these stocks are really sold off. Similarly, when there are other details as well, we'll get to them in a bit. Some in substances, the rules are not as bad as what was initially being feared. So watch out for these stocks. And in terms of more order wins and news flow around fresh orders, I'll watch out for ITD cementation, because the sum total of the orders that they've bagged is about 960 crores. It's a large number. So let's see if the stock reacts well. But it's going to be all about those mid-caps, Nigel, and whether the broader market can see some sanity and some stability today.
Well, I think the key to track from here on for the next couple of days is going to be the United States' role in the ongoing conflict between Israel as well as Iran. That's going to be very important, whether it's to the escalation side or to the de-escalation side. And that's a trigger that the bulls are fearing, actually. And that's why we've seen some kind of selling in the last few days. But to be fair, if you look at it in yesterday's trading session, the biggest negative was the kind of pain you saw in the broader markets, because the headline index didn't move too much. Towards the end, you had a 50-60 point downtick, but that was the weekly expiry-related factor, and that's why you saw a sharp fall in trade. However, the mid and the small caps, there was a lot of pain out there telling you that participation itself was fairly low. And that's precisely what happened. So you had a fall yesterday, but the volumes were much, much lower than what we have normally seen. So you compare it with the 10-day average, you'll say, well, there were a couple of large trades. Still, yesterday's NSE volumes were closer to around 14 to 15% lower in comparison to the average, even in stripped of some of those large trades. So the fall yesterday was actually on rather low volumes in the cash market. And that's also seen in the futures market, actually, because there has been some unwinding of positions, both on the Nifty as well as on the Nifty Bank side as well. Well, moving to one factor that's really cooled off is the index, the India VIX. Because in yesterday's trading session, when you have the index that's down, you'll normally see the VIX pop up a little bit. But all through this week, the VIX has been fairly stable. So the fear index actually has not spiked up, which is in a positive in that sense. Moving to the options data, then you had two strikes that were fairly active. 24,800 call, 24,800 put, both of them fairly active. You club the premium together, it's close to around 400 points or thereabouts, and you're getting a broad range, just in the near term. So it could be a strategy at play with regard to writing both those two strikes and pocketing the premium. But I think the near-term range, if you're looking at it, has to be around 24,600 to around 25,000. This is just for the day I'm looking at in terms of a tight range. And the Nifty, it's trading a little below the 20-day MA. By the end of today, you'll want it to end closer to this mark. So that's going to be the important mark. But otherwise, the 50-day MA comes into play, which is at around 24,450. The Nifty Bank, the recent low is at around 55,100. You don't want that level to get broken on the downside. However, the bull's wish list today is maybe the Nifty Bank ends closer to around the 20-day MA. In fact, crosses that as well. That's going to be the hope out there. Stocks that I'm looking at, well, the sensex changes will be effective on Monday. But today you'll have the readjustment that takes place. So in terms of inflows, we'll be keeping an eye on Trent as well as BEL. These two can have a bit of a move, particularly in the final hour of trade. And on the flip side, Nestle and IndusInd Bank could see some outflows. So I'll keep an eye out on all these four stocks. For the Nifty, it appears we're in a bit of a range. The broader markets, and I'll keep an eye out there. Yes, it was a bit of a painful session, hoping for a better one today.
Okay, all right. So let's get started then with the equity call of the morning. This is coming in from Chris Wood of Jefferies, who says that greed and fear still has a 19% weighting in property developers in the India long-only portfolio. He says BSE Realty Index is up by 35% from its spring lows on the 7th of April, though it's still 14% below the high reached in June 2024. Chris says greed and fear will make some adjustments in the India portfolio. This week, the investments in Larsen & Toubro, Thermax and Godrej Properties will be removed and replaced by investments in TVS Motors, Home First Finance and Manappuram Finance with 4 percentage points each. He adds an additional 1 percentage point each will be added to the existing investments in Policy Bazaar and Bharti Airtel. So lots of finance names there in the changes made by Jefferies.
All right. We'll track some of these as the day goes on. Let's welcome in Drew Pettit, Director, US Equity Strategy, ETF Analysis and Strategy Research at Citi, who is now with us on the program. Drew, great to have you back on the program. Thank you very much for your time. So every week there is a new one, it seems, a new crisis that is, but the market kind of moves on. And it has, in a way, moved on with kind of limited impact, even though oil prices have moved about 12-13% from last Thursday. I mean, other macro indicators have not really moved. Look at the dollar index or the US bond yields, etc. What do you make of it, and what is the market pricing in?
Yeah, look, so first off, thank you all for having me. Great to be back. And yes, you're right. It's been a revolving door of news flow here. And markets, honestly, a little bit, let's call them insensitive to kind of the human issues that are going on right now. Yeah, look, to us on the macro front, you really have to watch oil. That's what we're all taking our cue from right now when it comes to how we think about equity markets. Yes, it's up 10, 12% from last week, but you got to remember the base it's coming off of. We're talking about a 6 handle on Brent last week. Now we're kind of into the mid 70s as it's kind of cooled off in the last day or so. So look, to us, when we're trying to think about this fundamentally, being a little bit cold and calculated about this, if you see pressure in oil, if you see pressure in commodities, that leads to input cost pressure on U.S. businesses, that's when you would see pressure on U.S. equity markets. Right now, again, like you said, relatively well contained. So busy news week, but actually boring market week.
Busy news week, but boring market week. And, what do you make of that, Drew? Is it at some level a little bit of complacency, or is it just market wisdom that at some point a deal gets done and this will remain contained? Though, I mean, crude prices flared up again last night, so no one really knows.
Yeah, look, so some complacency maybe is starting to creep back in. We've watched our sentiment gauge for the past few weeks start to inch higher and higher and higher, but it's not at that point of euphoria where we were at the beginning of the year. So again, like just putting context of where we are today versus where we were, end of December, beginning of the year, sentiment is down a little bit. Index levels are down a touch. A lot of good news is still priced in. But right now, the macro front, whether it's rates, oil, commodity prices, and the dollar, it's not putting any added pressure on us that we didn't feel a month or so ago. So to some extent, yeah, the market's doing a reasonable job of kind of looking through a little bit of the noise. but it is pricing in a relatively benign outcome, like you mentioned.
Hi, Drew. Good morning. Good to see you. What about your preference for equities? You continue to like Europe and Japan, I believe, and emerging markets, you're not too convinced out there. But my question to you is, how do you approach global equities? What's your top bet? And from the emerging markets, though you seem to be a relatively underweight on emerging markets, is India top of the pack?
Yeah, so we'll go broad and work our way back in here. So look, we're neutral on the U.S. Again, we're talking about good fundamental stories, but a lot of good priced in there. So we'll kind of start neutral there. If you want growth exposure, if you want secular trend exposure, you definitely want exposure to U.S. markets. The overweights, Europe for bottoming earnings revisions and cheaper valuations there. Japan, again, some strength on the industrial side, even kind of before we got into this tariff mess. So you have some earnings momentum there. On the EM side, there could be some pressure, but what we want to own in EM, again, following our global strategist playbook here, India is at the top of the list because you have pretty good underlying economic trends. You're relatively insulated from trade, and you have a relatively good quality market. Outside of that, we're talking about names like South Africa, Chile, and Poland, who are all seeing inflections in EPS and relatively solid earnings and fundamental growth there.
Okay. All right. By the way, Drew, just one last question. Next week, there is that NATO summit, right? Which I think is going to put the focus back on, I guess, defense spending, which is the big sort of constant theme from market perspective as well. I mean, for example, defense stocks here in India have done very well. Defense stocks in Korea have done even better. In Europe, they've rallied hard. What is your sense? I mean, will that once again send a signal that around the world, countries will spend more and more as US kind of sort of vacates that space as the global policeman, as someone put it?
Yeah, it's funny. Like just pulling us back to the U.S., where my strength is, at least from a discussion perspective. Look, they have moved a lot. Industrials are the best performing sector year to date. That's where a ton of the defense names live. But the big but here is just how much growth are you going to get going forward from this? We're talking about defense spending budgets that may increase from kind of flattish to up 2, 3, 4, 5%. We get that the trend is inflecting. But to us, the real kind of defensive trade in the world right now is to add some growth names. While we're thinking about what governments might spend, where companies are going to spend more is on productivity, efficiency, and tech enhancement. So I think anytime you get pullbacks in the mega cap names and in the US indices, you want to buy into the growth stories that have more of a secular trend that we think feeds through to productivity, which all businesses need right now.
All right. Drew, we'll leave it there. Thank you very much. So not industrials, capital goods, but growth names, essentially, is what Drew is very much focused on. We'll take a quick commercial break here. We're going to come back. Let me just quickly run you through what's lined up, though, over the course of the show. 8:35, you'll hear from Amit Mahajan of Paras Defense and Space Technologies. Stock was up yesterday. What we'll also be doing is at 9 o'clock speaking with Abneesh Roy of Novama Institutional Equities, and we talk about trends in the FMCG space. 9:20, Harish Krishnan of Aditya Birla Sun Life Asset Management Company will be talking markets with us. We get our exclusive conversation going with the management of Britannia Industries at 9:45 on product mix strategy and growth trajectory for the company. At 10:15, Lata speaks with Neelkant Mishra of Axis Bank on India's macros and markets.
Time to take a quick break. We've got a lot of stock-specific action that's lined up in our top 10 segment. For the time being, I run you through the list. Banks, REC, PFC, IRDA, IRFC, all of them will be reacting to positive news flow. Add to the list, Nestle India as well. On the flip side, Keynes Tech, Sai Life Sciences, Sun TV Network, as well as Natco Pharma will be reacting to negative news flow. Take that break, come back, get into further detail on all of these names.
Welcome back. So as we've been telling you, the cues are fairly mixed. Many of the Asian markets are down. Japan is down. Mainland China is down. US futures are down. Hong Kong seeing some green. So it's a little all over the place. Let's pull up the implied open. It's also cautious, just 8-9 points lower. That's what we've got. Well, there are, of course, plenty of stocks to discuss, and our team is standing by with the CNBC-TV18 list of top stocks to watch. Morning to everyone. Let's start off with Lata by understanding the final norms that have come in now on project financing, and they seem to be less onerous than what the street was fearing. Lata, good morning.
Good morning. Well, the Reserve Bank had, by its draft rules, threatened, if I may use that word, very high provisions on infrastructure loans. See, the logic for that was many of these project finances were in the previous AQR, if you remember, many of them had gone bad. So now in good times, they were saying when you give the loan, set aside 5% as provisions. And if it works well, then over the next 5 years, you bring it down. That was the idea. But those were the draft rules. The actual rules now, which came yesterday, say that you don't have to set aside 5%, you set aside 1% when you give a project finance loan. That is versus 5% in the draft. And for commercial real estate, you have to set aside 1.5%, again, versus 5%. This is for under construction. Once the operation starts, then the old rules say 2.5%. The new rules say standard, like any other loan. You know, home loan, 0.4% is set aside. So once it starts operating, you only keep 0.4%. It becomes a standard loan. If there is a DCCO, now what is a DCCO? Date of commencement of commercial operations. If the date of commencement of operations is deferred, then in the old rules, you have to keep old rules. As in the draft rules, you have to set aside 2.5% as provisions. Now you have to set aside 3.79% of the loan for every quarter. If you push it by 1 year, then it will be 4 times that amount. But otherwise, as you push it forward, you set aside a little more by way of provisioning, much less than the draft rules. Again, as I told you, for commercial real estate also, big relief. Original provisioning was 5%. Now it is 1%. The new rules are most importantly applicable only for prospective loans. The draft had said that all the infrastructure loans already given will also go through this provisioning. So many projects are under construction, but that will not apply. Now it is only when the financial closure has been achieved hereafter. Only for those projects this will be applicable. So, positive for banks, for prospective loans, positive for NBFCs like PFC and REC, REDA. But just remember, they already have higher provisioning. They have what you call ECL norms, expected credit loss norms. So the point is the new rules are same as the ECL norms. You can say they are not stricter than the ECL norms. To that extent, it's a relief. But my sense is we must also watch commercial real estate stocks. And a more general point, I think the Reserve Bank, it was evident in the CRR cut itself, is becoming more benign to banks. There was a time when the Government of India, the Reserve Bank, all of them thought these guys are the king of all the lazy savings in the country. So you impose, social responsibilities on them. The CRR cut gives the indication that, banks are having a problem finding savings. We have to treat them with a little kinder hand. They have to compete with mutual funds. And therefore, even the infra loan provisioning seems to indicate the same thinking.
Okay, all right, got it. Thanks very much. So that's quite interesting. Basically, the norms are not as tough as what the draft rules were indicating. So good news coming in for the lenders there. Let's move on. Vivek is joining in. He's watching out for, I think, Keynes Tech and SciLife. Vivek, morning. What's happening?
Good morning. Well, the gush of fundraising continues. So as far as SciLife Sciences is concerned, it's a block deal. Remember, last evening we had the block deal where they were looking to sell close to 6% stake. Now we understand that they've gone ahead and upsized, and now they're looking to sell close to 2.1 crore shares. So almost a little over 10% equity is expected to change hands today. The offer size will be in excess of 1,450 crore. Floor price at 710 rupees a share.
Now, the other stock on the radar is Keynes Technology. So now, the company has gone ahead and launched a QIP for a fundraise. They're looking to raise close to 1,600 crore. The indicative offer price at a little over 4% discount will come in at close to 5,345 rupees a share, which indicates an equity dilution of close to 4.5% equity. Remember, Keynes Technology had already taken the board enablement resolution to go ahead and raise funds via the QIP route.
All right. Vivek, thank you very much for that. Well, let's talk about the Sun TV story now, where a family feud has emerged. Reportedly, it's emerged reportedly. It's a money control exclusive. My colleague Chandra Shrikant joins us with details about this one. Chandra, good morning.
Hi, Prashant. Good morning. So this is a big fight that has broken out between the Maran brothers, DMK leader Dayanidhi Maran, who's leveled grave charges against Kalanidhi Maran, his billionaire brother, and the chairman of Sun TV Network, which is one of India's largest listed media firms, with a turnover of 4,500 crore and a net profit of over 1,600 crore. So, this legal notice basically alleges that Kalanidhi Maran, the chairman of Sun TV, engaged in what he describes as fraudulent practices, cheating and money laundering to essentially wrest control of the Sun TV network. So in his legal notice, Dayanidhi Maran has asked for the restoration of the company's shareholding to the original structure established in 2003. Now, this notice is dated 10th June 2025, and it's being served to Kalanidhi Maran, his wife Kaveri Maran, who's also part of the Sun TV management, and 7 other respondents. And it has threatened civil, criminal, regulatory, and enforcement proceedings if Kalanidhi Maran doesn't comply with Dayanidhi Maran's demands. So he wants him to restore the shareholding to the original families that control Sun TV, and he also wants them to return anything that they earned in terms of dividends or assets over the decades. So this is going to be interesting because, it's been over 2 decades, nearly 2 decades since Sun TV became a listed firm. So, will it be pragmatic to go back and revisit the shareholding structure of 2003? Secondly, the political implications that this will have, will the DMK step in perhaps to mediate between the warring siblings? And of course, we'll have to, see how the stock price reacts this morning. So a story to watch out for.
All right. Good to see you in, Chandra. Thanks a lot for that story. We'll keep an eye out on the stock, and in all probability, it should be a bit of a negative reaction. Let's hop across to Vinny, though. She's joining to tell us about Nestle as well as Natco Pharma. Morning, Vinny.
Hi, good morning, Nigel. So firstly, talking about Nestle, we are expecting some bit of a green year. First ever bonus that the company has said that they will be announcing. This is expected to come in on 26th of June when the board will be meeting to mull the issue of bonus shares. So first time ever, this is going to be interesting. We're expecting green on the screen. Do not forget the last time there was a stock split that happened for the company was in Jan 2024. Since then, there was nothing. Now this bonus issue is what everyone will be watching out for. On the other hand, we're watching out for Natco Pharma, expecting red here. Why? Because the US FDA has completed the inspection for its Hyderabad facility. Form 483, 7 observations have come in for this one. Though Natco Pharma said they're confident of addressing in terms of these observations that are there. More natures of the, or what is the nature of these observations will come in as we get more details of the Form 483. But right now, 7 observations, so a bit of a negative coming in there for the company.
Okay, all right. Got that, Vinny. Thank you very much. So both Nestle and Natco are going to be on our radar as well. Let's quickly recap our list of top stocks to watch then. The ones that have positive news flow this morning are banks and, of course, lenders like REC, PFC, IRIDA and IRFC on the RBI project finance norms. Nestle India as well on the green side. The ones that have negative news flow are Keynes, Sai Life Sciences, Sun TV and Natco Pharma. Okay, let's look at commodities now, specifically crude oil. Considering there was a bit of a flare-up last night, again, we have Manisha joining in with the latest. Manisha, good morning.
Morning, and thank you for that. So we really has 3% of gains in the overnight market, supported by the geopolitical premium. There are statements from Israel suggesting that they are going to intensify attacks against Iran. The meanwhile, White House says that Trump will decide in 2 weeks on if to strike Iran. So this uncertainty is what is keeping the prices on the higher side. As you see, no sign of exit strategy from either side. What is capping the prices, though, is the expectation of higher supplies in the second half of this year and in 2026 as well. And production elsewhere has offset the disruption impact, and that is what the markets are looking at right now. But barring crude, almost everything has seen a bit of a profit taking. Gold is now trading at a 1-week lows on Fed hawkish stance. Silver fell 1.5% overnight. Copper fell 1%. And we're looking at further lows coming in for ferrous metal like steel and iron ore as well, which are trading at a multi-month lows right now. So as I said, barring energy, where crude and heating oil, gasoline, all of that is trading on a firmer note, almost everything slightly down on profit taking.
Thanks a lot for that, Manisha. Well, let's get back to a couple of stocks that we're looking at. Sensex, Rebalance and FTSE All-World Index adjustment will take place today. We just mentioned the Sensex adjustments. Vivek joins us to fill us in with more details. Vivek?
Well, that's right. So come Monday, the Sensex will have a new look. So you have two inclusions at the expense of two exclusions. Trent and Bharat Electronics come in, both of them in today's trading session, expected to see inflows of over $300 million. Nestle and IndusInd Bank will make way. Nestle will see outflows of almost $220 million, while IndusInd Bank will see outflows of over $130 million. Now, there is also the FTSE rebal that will take place in the session today, especially in the last half hour. So it's it's a net inflow event as far as India is concerned. Which are the stocks that make the entry? Most of them are the new listings. So Hyundai Motors, NTPC Green, Vishal Mega Mart, Warrior Energy and Swiggy make their entry into the FTSE All-World Index, while in the All-Cap Index, some of the smaller names like OneSource Specialty, Sai Life Sciences and Afcons Infra make their entry. Also remember, today there is also an MSCI event. The company that got listed Energy, which was the demerged entity of Siemens, that is Siemens Energy, will be deleted from the MSCI Global Standard Index. Expect outflows of close to $150 million. This is conditional to the fact that the company is not at the lower circuit today.
Okay, all right. Thanks a lot for that, Vivek, for joining and giving us all of those details. Well, we've got a lot of stocks that are going to be in focus today, and we have our market expert, Hemang Jani, who joins us on the show. Hi, Hemang. Good morning and good to see you win. Hemang, we have got these project financing norms that are out now, and they're not as bad as feared in the draft, which will be good news for a few stocks, BFC, RAC, IRDA as well. What's your view and your view on the stocks as well?
Yeah, good morning, Nigel. Thanks for having me. So clearly, the norms have come as a bit of a positive surprise. And I think there is going to be a big relief for corporate lenders, especially PSU banks and infra NBFCs. And, this eases concerns over the cost overruns, the potential pullback of funding. So if you read that in line with what the RBI has done in terms of easing liquidity, by, CRR cut and the repo rate cut, this is certainly going to be a big positive and a relief for some of the project financiers, be it the PSUs like REC, PFC, or IRDA, or, maybe many more companies, because I think the liquidity and the ability to do business at these terms would be much, much better for these companies compared to what the draft guidelines were.
Okay, all right, got that. So that's out of the way. Let's focus on Sun TV. There's a spat taking place at the promoter level. The company is valued very, very attractively because it's got the IPL franchise in there. They're sitting on solid cash as well. And yet it's been such a big underperformer. What's your view? Today the stock is likely to see a bit of a knee-jerk reaction. Going by the valuations, the business as well, would you jump in to buy, or would you say there's no much clarity on what they'll do with that cash next, so you'd rather stay away?
So, Nigel, I think first time, there is a public fallout between the members of the Maran family. So, of course, there is going to be a bit of a knee-jerk reaction. We don't know the magnitude of the issue and how exactly it's going to pan out. But when you look at Sun TV, it has always, had this kind of a cash, very high operating profit margin. But the way the entire this OTT and the, digital disruption is at play, we do not see Sun as somebody who's really been able to, come out with any innovative solution to that disruption thing. Even numbers, if you look at the last 2 or 3 quarters, have not been that, encouraging. So not really, big positive of this name. I would certainly stay away, even if the stocks, let's say, correct another 3-5%.
Okay, all right. Hemang, stay with us. What we're going to do is take a quick commercial break here. We have Amit Mahajan of Paras Defense and Space Technologies joining us. Stock was up yesterday. He's done quite well. We'll ask him about defense spending, orders, business outlook, all that coming up.
Welcome back. You're with us on Bazaar Morning Call. Well, we're putting the spotlight on the defense space for very obvious reasons and looking at one of the companies, of course, listed here in India. Paras Defense and Space Technologies is the company on our radar as the conflict in West Asia rages on. Let's look at whether Paras can be impacted or if there is any sort of a risk to the business plans whatsoever, because Paras has been, of course, catering to major Israeli customers as well. Let's talk about this with Amit Mahajan, Director Technical and R&D at Paras Defense and Space Technologies. That's exactly the question, Amit. Just tell us your engagement right now, at what level in terms of what projects with the Israelis? And have there been any phone calls, conversations of the last couple of days, given what's going on?
Firstly, good morning and thank you for having me over. Our engagement with Israel is less to do with exports and more to do with technology tie-ups and bringing cutting-edge technologies to make in India and then provide it to our Indian customers. So if you look at it from that standpoint, whatever is happening in that region, that may little slow down that particular process, but these are all businesses which are for the future. When it comes to current business of Paras Defense, the reliance on export is minimal and reliance on exports to Israel in specific is limited. So we are exporting to US, we are exporting to Europe, we are exporting to Far East as well. So all of these areas are still there when it comes to export market, but when it comes to technology tie-ups, these technology tie-ups are well strong even right now, and the most of the technologies are already shared. Plus, Paras has an in-house development capabilities which constitute to almost 80-90% of the product revenues that they deliver today. So the dependency on technology on outside world is limited.
So, no, get that point, Amit. I mean, no one is saying that there's a huge sort of 50% exposure to your revenues. Not at all. We're just trying to understand the level of engagement you're at. So you're saying a lot of the tech transfer conversations, they were anyway for future projects. What is the kind of delay you'd anticipate?
About a week or 2 weeks.
That's it?
That's how agile the discussions are going on.
Oh, okay. So you're not expecting any major delay in some of these projects that you're talking about, which is, I think, a JV for hydrogen-powered drone systems. I think you have an MOU for drone camera technology as well. Also tell us, aren't you also exporting to some Israeli customers? Are there absolutely no exports to any Israeli clients?
Like I said, the exports to Israeli customers, say if I have to put an example of a camera, then I'm giving the lenses which are manufactured in the premises of Paras and giving lenses as a component for our Israeli customers. Now, if the value of that lens as compared to the business of Paras Defense is very, very minimal, the percentage of exports to Israel in specific is very limited.
What is that percentage? Just for our reference. I know it's very small, like you're saying, but just so that we know.
It will be less than 5%.
Got it. All right.
Hi, Amit. Good morning. Good to see you in. But exports as a percentage of business, I think it was in mid-teens, right? Given the way the globe is, evolving, what kind of exposure are you looking at with regard to export revenue? Point number one. And also, if you could tell us imports, you'll import some part of your requirement. Are there any supply disruptions? You heard of freight rates going up, shipping industry as well as going through various other factors at play out there. So give us some kind of color on both imports as well as the exports.
So like I've always maintained that our exports is always our plan B. And it was for different reasons, for sure, that our domestic positioning, our domestic market and domestic procurement is at all-time high. So for me to do an export, I'm going into a competitive space. That was my reasoning for why I always maintained that export is going to be plan B. But like I'm telling you, it's plan B. So my export percentage was always between 10-15%, and that too something which is coming out of self-weight. I am not planning, I am not basing my growth on the basis of the kind of exports I'm going to do, be it Europe, be it Americas, or be it Middle East region that we're talking about. But when it comes to imports, we currently do not see any, we do not have any indications as per the disruption particulars when it comes to our supply chain. About 30% of our dependency is on export components, import components. And we don't see, as of now, we've not got any indications that any of those disruptions are going to affect our business line.
Right. Amit, slightly, as we wind down, slightly larger question here. With regards to this conflict in Iran and Israel, I think, right, what is becoming clear and maybe will get clearer is that, you know, air defense systems are much more crucial. It looks like, you know, for example, if you're tracking what's happening, I mean, Iran is able to overwhelm Israel's air defenses, right? In a big way, and defensive systems would need to be. I mean, you can't produce them at mass scale. Maybe you can. I don't know, but they need to be a lot more accurate. Each of those things cost apparently the Arrow, etc., costs $2 billion a piece. So. Do you work in that segment at all? Do you supply or work on platforms which are essentially air defense?
So if
do you supply anything?
If you have a look at our presentation, which was updated maybe far before the kind of conflicts that we're looking at, right? So although we don't do a complete air defense solution, we do a lot of components for air defense. Today, the biggest contract that we have received from DRDO is for an air defense application. So air defense is going to be the key. It is a very, very complex technology. Like you rightly said, some things get intercepted, some things don't. So it has to be technologically multi-layered. So it has to cater to something which is low flying, something which is very, very fast moving, something which is high flying. So all of these, it's a very complex thing to first detect it and then subsequently track it down and then intercept. So this is it's like a very complex technology, and we are very proud that we are significant part of this air defense currently for India, and then maybe tomorrow for export as well.
Which platform in India, if you can share, and what exactly do you make for them? I mean, to the degree that you can tell us.
We are associated with almost all the programs that you think have played a role in the conflict that we are aware of. So we are one of the first few companies a part of BrahMos. So from the first BrahMos ever made till all the BrahMos that are being made, we are always a part of it. From
so
that
just
to a laser based interception system. So we are a part of all the air defense systems.
Got it. And Amit, finally, just to get a sense, and this is a question, say, 2-3 years out. Obviously, you've got a big opportunity in India, and you've spoken about those numbers, right? That you're expecting 40% revenue growth this year, etc. The export opportunity, I mean, and I'm just wondering, because after Operation Sindoor, we understand that a lot of inquiries have been coming to Indian vendors, suppliers of different parts, subsystems, etc. So I think exports are about 16% of your total pie right now. Are you seeing heightened inquiries from any, external geographies, and which would those geographies be? What is your own take on the growth in exports?
So the effect of Indian technology working in a particular conflict is definitely going to have a very, very positive impact when it comes to outlook of a foreign company looking at trying to source from India. Earlier, it used to be only low cost. Today, it's going to be low cost and field proven, if I may call it that. But what I'm trying to say here is the geopolitical scenario and the demographic positioning of India when it comes to global countries. I think that is going to be the key why India can be looked at as an ally by many countries who are mutually conflicting. So I think India will slowly tend to become an export hub of defense technologies.
Okay. All right, Amit. Got that. Thanks very much for your time. Appreciate the conversation this morning. Well, that's Paras Defense, one of the many, many companies in the Indian defense ecosystem. Let's go back to Hemang. Hemang, I guess you might have been able to hear most of that conversation. Always a hot area, right? And lots of opportunity. The narrative is obviously very strong. The question is you have to buy the right kind of stock at the right price. So do you see anything out there?
Absolutely, Surbhi. I think both in India and globally, the way the geopolitics is panning out, there is going to be a significant opportunity in upgrades by majority of the countries, be it Europe, US, Middle East, and of course Asia. So yeah, of course, India, we have seen that post Operation Sindoor also there has been a good amount of interest, and we do like Bharat Electronics and HL at this point. And when I look at the overall, revenue that they are generating from defense, about $3 to $4 billion, versus that, if you see some global defense companies, Lockheed Martin or RTX Corporation, Northern Grumman, the spend is about $40 to $60 billion. So I think the opportunity size is very large, and given the upgrade that is going to happen, there is definitely going to be an interest over there.
All right, we'll take a break, Hemang. Stay with us. Markets are absolutely flat. We'll come back with some technical trading ideas as well, running up into market pre-open. 30 minutes out.
Welcome back. 16 minutes to go before Friday trade kicks off. Let's ask Hemang for some ideas. Hemang, so this week has been all about taking profits from your mid-caps that are working, right? Mid-cap index is down 2%, small cap is down, micro-cap index is down almost 3%. Tell us, in this environment, uncertainty, all that aside, any interesting stock ideas?
Surbhi, I think we've seen a significant correction across the mid-cap names, as you rightly said, mid-caps and small caps. So, within that, I think something like Swiggy, Eternal, these are the names which have really remained quite resilient. And when we look at the performance, the competitive intensity, and the fact that Swiggy, the QC business is quoting at a, almost about 85% discount to a Blinkit. So I do think that, some of these platform companies offer great opportunity. And from a short-term results perspective, we do think the IT, could surprise positively, particularly something like Infosys or HCL Tech, Coforge. So purely from a quarterly numbers perspective, we would have a positive view on some of the IT names.
Yeah, positive on IT names. So that's coming through. By the way, Hemang, just a quick word, right? Yesterday, mid and small caps sold off so aggressively. Almost actually 2% on both mid and small cap indices. Anything you picked up out there in terms of chatter? What was driving it?
I think, Prashant, because of the way the block deals are happening and the liquidity is being sucked out, you would see the pressure on the less liquid names. So I think it was part of that. I don't think there is anything specific as a concern. Of course, if the crude remains at an elevated levels, you would see a bit of negative for our markets. But I'm not reading anything specific for the mid-cap and small-cap names at this point of time.
I got that. The retail names have all been in focus, and names like Vishal, Megamart, etc. Quite a bit, particularly so. Do you have coverage on? Have you looked at Vishal Megamart as a stock?
No, not looked at that, but I do think that, whenever you have such a big stake sale, I mean, I'm really surprised as to why such a, a huge, almost about 20% or thereabouts, the promoters are selling at this point of time. So the company did, the fundraise or the IPO very recently. So that really surprises me. I'm not really a big fan of, companies where the promoters are selling a significant stake and, I try to find a value there. But I think trend, certainly, if you see, some correction over there, post the analyst made, that would certainly be one stock that I would be positive on.
But, then if promoter selling stake is an exclusion criteria, and you have to exclude lots of stuff because most promoters are, right?
What I meant is, Prashant, significant, like a small 1-2% stake is something that one can really understand.
Point taken. The other one was Dream Folks, and I think we'd highlighted this yesterday. Stock ended 10% lower. The news, of course, was that their Dream Folks, after service disruptions, banks like ICICI, Axis, etc., looking to move away from Dream Folks. Any thoughts if you have coverage? Again, not a very old listing.
Definitely, this news came as a major negative surprise. I don't know exactly what were the reasons for the, disruption, but I think, there is a lot of excitement around any of these, service providers, and sometimes the valuations are stretched. So whenever you have this kind of a negative surprise, the stock will correct. Not looked at Dream Folks in detail, so no real view over there.
Okay. All right, Hemang, good to have you on the show this morning. Thanks very much for all the inputs. Appreciate you being with us today. Well, with that, let's move on and put the spotlight on the FMCG space. Quite a few developments happening there. We have Abneesh Roy, Executive Director at Nuvama, joining in. Abneesh, morning. So I want to actually start off with the note that you guys put out on Trent. I saw that because Trent, I think, spoke to the entire analyst fraternity, explaining their roadmap from here on. And I think the headline is that 25% growth on a sustainable basis is something they think is doable and they think is healthy. What's your sense? Because the stock has actually recovered quite well after falling from its hallowed highs. It fell down and it's recovered almost $1,000 in the last 4-5 weeks.
Yeah, thanks. Good morning. We remain quite positive on Trent. So yes, the analyst meet was useful, and then the annual report this time is quite detailed, gives a lot of insights. So you're absolutely right. This is a compounding machine. We see 25% plus compounding continue. And company has highlighted 3 more verticals where I think longer term growth can really improve. Innerwear, and definitely in terms of footwear, and even in terms of beauty. These are initial days. In fact, in footwear, already they are one of the larger players in the listed space. Company is investing a lot in terms of automation and the customer experience, a lot of RFID. This will really improve the inventory management, tracking, etc. So the street had a concern on the same-store sales growth. Of course, the base was high. On that base, there was some slower SSG. But company highlighted that they are looking at more density of the Zudio stores and more market share. See, whenever they'll open more stores in a micro geography within the same city, same store sales growth will become lower optically. That is a wrong way of evaluating a company like Zudio or a Trend, because ultimately company is aiming for a higher market share and better experience and larger stores also. So we remain quite positive, and the healthy correction which had happened, a lot of that, as you rightly highlighted, has been recouped. But we see 25% compounding continue for this company, medium long term. So we are quite positive. All right. 6627 is our target price.
6627, got that, Abneesh. And good to have you on the show, Abneesh. Let's talk about the other name, Avenue Supermarts. They've entered a new geography, UP. And, the street liked that, actually. What's your view on the stock?
Absolutely. Here also, if you see for Avenue Supermart, Agra opening and Uttar Pradesh kind of such a large market. Uttar Pradesh population, if you see, is larger than many countries. So I would say that this has to be taken seriously, and medium long term, Uttar Pradesh can be a very large market for Avenue Supermart. They already had some presence in the NCR zone, but Agra store opening clearly lays out the ambition for that state. And if you see out of the 28 states, just 4-5 states, DMart has a good presence. So we see the other states also catch up. Near-term concern remains that in quick commerce, new players are entering. So that concern continues to remain. So margin pressure in the near term will be there for DMart. But from, again, a compounding new store expansion, that will definitely sustain. So we are positive on DMart from a longer time frame. Currently, our top picks in this space will be Trent, VMart, and Titan.
Okay, Trend, VMart, Titan. On Avenue, though, just a quick one. We were discussing this with Mangalam yesterday. How much is these categories like apparel and low-value fashion, etc., as a percentage of sales? Because presumably those are doing much better than traditional core FMCG products, right?
Yeah, apparel and general merchandise is almost 1/4 of the business, and that is a higher margin business also. And there, if you see the kind of price war which is happening with the quick commerce will also be lower. So yes, FMCG, we see that it's more competitive for the retailers. And definitely, if DMart can keep improving the assortment and the price value equation, sharper pricing, which say trend Zudio has demonstrated, say in apparel, that would be the right, I think, strategy for DMart to diversify and get more out of apparel and general merchandise. So that's a higher margin business also.
Okay.
You have coverage on Vishal Megamart, Abnish?
No, we don't cover, but yes, in terms of growth metrics, in terms of sharper pricing, that is a very strong number the company has been delivering. And in the medium term, I would expect, given they have done well, that can continue. The concern on that P stakes, P-owned companies will have that, right? We should not club typical promoters of, say, Avenue Supermart and compare that with a P-promoted company. That P promoters have a definite timeline and they will keep doing that. So that's not the right metric, say, that the promoter is selling. I don't think that is a big concern. But yeah, from a growth metrics, I think the company, Vishal, is doing quite well. And I would expect that to continue medium long term. We don't have a coverage on this.
All right. Abneesh, what about Sun TV? There is value, there has been value, but now you have another problem. That's the promoter feud. What's your view on the stock?
Yeah, the valuation comfort in Sun TV has been high, but if you see 3-4 key things, post the Disney and overall Star Viacom merger, definitely the number one player is now much larger than other players. Second is whenever promoter feud happens in any company, the stock generally has more concern, and definitely the management bandwidth also could get allocated for the feud. So that's a negative. So yeah, Sun TV needs to have a more professionalized approach, more aggressive approach in terms of OTT also. So near term, we'll prefer more Z, PVR and Saregama over Sun TV. Sun TV valuation comfort is there, but this new development of the promoter feud, I think that's slightly overhang on the stock till we get clarity.
Right. And this entire Z thing now, how do you view it, Abnish?
Yeah, I think any company where promoter has more skin in the game, on paper it is good. What I think investors would now like to see is how is the allocation of the huge cash on the balance sheet. Almost 2,500 crore cash is there on the balance sheet. And once promoter puts in money, it will become almost 4,700 crore cash. That's a huge portion of their market cap. So how that is used in terms of which acquisition, whether it adds value in terms of more digital play, more niche content, that will be one. Second is, of course, in terms of transparency and corporate governance, you would again expect that the last 2 years, the improvement which is there, that has to be there. Third is on the macro, right? The overall TV broadcasting companies are struggling on the advertising revenue across the board. Because of this geopolitical development, crude oil prices has gone up, which puts a risk on FMCG advertising. That was supposed to recover in FY26. For Z and Sun TV, both common. I think that becomes a risk because of the crude oil spike. So overall, valuation comfort in Z is there. But now we need to see on allocation and usage of the funds and on the transparency, which has improved. We would expect that to sustain.
Is it just just 30 seconds, Abnish, is it just a valuation trade, or you think they'll be able to come back in a big way, competition-wise?
The competition has rationalized. In Z5, we expect further significant reduction in losses. And we do see that margins will keep improving because Z5 losses will reduce. Across the OTT industry, focus is now on sustainable growth rather than just reckless content spends. So yeah, it is an improvement in terms of margins. At subscription revenue, we have more clarity. Advertising revenue continues to remain a challenge. Now, with the skin in the game for the promoters, we will have more of the involvement, and the concern reduces. But yeah, numbers also we see improvement over the next 2 years.
All right. Abnish, thank you very much. Sort of good speaking with you, and appreciate you joining us here on CNBC-TV18 as always. Well, we're broadly staying in the, in the same kind of arena, but we're talking about different different business line. Delivery is what we want to talk about. Mangalam is here with, this one and why it's in focus. Mangalam, over to you.
Oh, well, good morning. So if you look at delivery, the stock ever since they announced the acquisition of Ecom Express has rallied about 41%. This at a time when the Nifty is just rallied about 8%. So there has been a strong outperformance on hopes that there is industry consolidation and delivery would stand to benefit from that. But Jefferies thinks otherwise. Why is that? Because one of their bigger concerns is their client, Meesho, which accounts for nearly 40 to 50% of their e-com parcel sales. They have been insourcing logistics. So Meesho started their own captive logistics, and that's always a worry when a company is, the third-party logistics player, and that they believe could further pressurize their e-com parcel business. If you look at it, they believe that e-commerce itself, after the post-COVID high CAGR of almost 30% over the last 5 years, could moderate over the next 5 years to about 10%. So growth itself is coming down, and in light of that, other companies are using their captive logistics, some of their bigger clients, and that would mean that their market share could nearly halve to 34% by FY28, and which implies that there could be case for a downside on their overall business despite the consolidation of e-commerce express. So they have cut their target price from 500 to 315 on delivery. But apart from all of this, the other concern for delivery, as Abneesh earlier pointed out as well, PE exits could be one of the reasons for a lot of these PE-owned companies. For delivery, there is no listed promoter, but a lot of funds own the stock. So maybe any sort of liquidity event out there is one of the risks as well.
All right. Mangalam, thanks very much for that. So delivery down about 1.25% or so. Let's just look at the PFC and REC stocks as well, and go back to the relief which the RBI is, in a way, provided 2% higher on PFC. REC in the pre-open is settled about 2% higher as well. Let's just go back to Lata on that big story, easing of project finance norms for banks, NBFCs. Lata, take us through it.
Well, the draft had threatened that there will be very high provisioning of 5% on all project finance rules. But yesterday we got the final rules, and they were far simpler, far easier. If for any new project finance loan, banks and NBFCs like PFC and IREDA have to set aside 1% of the total loan as provisioning. And once it's the old rules, as I said, the draft said 5%. Once they start operating, then the provision falls to 0.4%. In the draft, it said that even when they start operating, it should be 2.5% and gradually brought down. The idea was, of course, to build provisions during good times when infrastructure projects go bad during bad times. But the point is the new rules, actual rules, are far simpler. Also, for commercial real estate, you have to set aside only 1.5% for project finance compared to the old 5%. If anything went bad and the date of commencement was deferred, then an increased incremental 0.37% of the loan has to be set aside as provisions for every quarter deferred. In the old draft rules, it would have been 2.5%. So all told, it's easy. Also, the new rules will apply only for forthcoming prospective loans which are signed after October 1, not for the old loans. So relief for NBFCs and banks.
Right. Just a couple of seconds to go for the market open. Lata, thank you very much for that. We'll try and speak with some of these banks and NBFCs as well to better understand how they are looking at some of this. First rates starting to come up. It's been very, very quiet starts for the last many sessions, actually, last 3-4 days now. And I think same is the case today. Nothing on the Nifty. 24,814, almost unchanged. The Nifty Bank has got slight amount of lift, about 0.15% higher, 55,700. The mid-cap index is up about 0.25%. And I think you've got the small-cap index, which is starting about 0.13% up as well. Right out of the gates, you basically have advanced decline 1:1, but that's just within the first 1 minute that we are looking at things. Okay, now the Nifty has got some momentum going as well. So 50 points, we're at about 24,850 at this point in time. The Nifty heat map, it's bulk of it, most of it up in the green. Very few names are down in the red. About 5-6 names are in the red. Everything else is starting higher. Surabhi.
Market in Friday mood, it seems. It's a fair amount of green on the screen. By the way, the project financier stocks, they are all up and about. PFC, REC, IREDA, HUDCO. Gains between 1.5% to 3.5%, depending on which one you are looking at. And that's, as Lata was just explaining to us, the final norms that have come out are less onerous than the draft norms. So it's a big relief and an overhang which has been removed. For the Nifty, what is taking the Nifty up 60 points? Let's find out. Nestle, Trent, There's Tata Motors. A lot of the banks are doing very well. The bank nifty is actually much better than the nifty. The bank nifty is up 0.4%. SBI is the one which is, pushing it right on top. Axis Bank is having a good morning as well. Let's see what's up with the HDFC Bank. Also minor gains coming in there. ICICI Bank is very quiet, 0.2% up. But banks looking good. Overall financials, Jio Finance also 0.5% higher. Shriram Finance, Bajaj Finserv. So financials are a solid spot. Nestle, remember, is looking at a bonus issue soon. So 1.5% up on that stock. Trent continues its good form from this week. There's a little bit of buying on something like Asian Paints as well. So that's the gainers tally. On the losing side, not too many stocks actually. Hero Moto and Bajaj Auto, which have had a good week otherwise. They're cooling off a little bit. And IndusInd Bank slightly lower as well. But otherwise, 78 points higher, Nigel. I think the bulls will take it with both hands.
Well, that's right. Surbhi, there's Northern Arc. There's a large trade that's taken place, actually. 14% equity that's up on the screen. It'll be interesting to see who exactly were the parties. Leapfrog, that's one that has close to around 16% stake. Augusta Investments, that's another one that has 16% stake. So could be a large holder that's in fact, pressed the exit button. Large trade taking place explains why the stock is down close to around 7%. What's taking it on the chin? Sun TV, that's lower because of the promoter feud out there. ITD Cementation, that's a stock actually that's doing well. The order win that's come in there. So that's why that stock is up and about in today's trading session. On the Nifty, typically you see this. In the previous day, if you have a low close, yesterday the last tick of the day was actually minus 60 points. The next day you normally see that being made up, and that's precisely what's happened. So that's why we're up close to around 80 points. The fall that we saw in the final 30 minutes of trade yesterday was more to do with the expiry-related factor. What else is doing well? Finiotex Chemicals, that one's come on the radar. That's up close to around 4%, one of the winners on the Nifty. So good up move is what we're seeing on that one. Axis Gates, actually, that's been moving from circuit to circuit. Today as well, it's up close to around 3.5%. So good move is what we're seeing on that particular name. On the downside, Northern Arc, that one deserves special mention. 2 crore shares changing hands, I think. So on Sai Life as well. So 10% equity, that's out of the way. That stock is well down, only around 1% for such a large trade. Prashant.
No, absolutely. Axis Cades is, was up 5% yesterday, and I think it's starting higher right now as well. So 3.5% higher. We'll talk more about this one as we kind of sort of go along. But you've got a market which I think is looking much better now. The Nifty will come up on your screen, and we'll then talk about more stocks, etc. So 76 points. It's a better Friday as compared to any of the last 4 sessions that we've had. Harish Krishnan is with us, co-CIO, head of equity at Aditya Birla Sun Life Asset Management Company. Harish, good to have you with us here. Thanks very much for your time. I want to just start with at the margin all the blocks, etc., which you've been seeing. And the interest is such that at least twice or thrice this week we've seen these offerings upsized because of greater demand. Have you been sort of participating, and how are you viewing in this increase? It's not a new phenomenon. 2024 was very big with regards to all these offerings. This year turning out to be pretty good as well. Any specific situations you've participated or interested in, and your perspective?
So, good morning, Prashant. So there's been a lot of action, as you rightly pointed out, with a lot of private equity, venture capital, secondary offerings that are coming through, even promoter blocks coming through. And that's kind of putting a lid in terms of the overall market move, given the fact that there has been such large supply. We're talking in aggregate of 50, 60, 70,000 crores happening in a fortnight's time of supply that comes through. What we've been far more, selective in terms of our approach out here. Names that we already own, where we have had a positive view, we do take such liquidity opportunities as an option to top up. In certain cases, which are very interesting, where we have not had much exposure in the past, we are also kind of getting into such names. But we've been very selective as far as the overall block participation is concerned over the course of the last few months or so.
Okay. All right, Harish, good to have you on this morning. So market has been range bound, but it's also been sort of gradually, quietly grinding higher, right? So would you be in the camp that believes that perhaps there's still enough fuel left in the tank? And then, would you be cautious in terms of keeping some money on the sidelines, or would you advise being fully invested? And if so, then then where?
So we are reasonably fully invested as a fund house, and we've been having the stance for some time. So it's not something further now. During the phase of January, February, March, when markets did correct, asset allocation products like Balance Advantage Fund, etc., went up very significantly into equities from about 38-40% of net equity. We are now currently at about 75% net equity. But that is, when opportunities did come through, we did increase our allocation. In terms of which are the sectors or which are the areas where we are deploying incrementally to our capital, as far as a fund house is concerned, we continue to view opportunities in private sector banks. We continue to increase allocation into resource plays, be it into cement, metals, materials, chemicals. That's an area where we have deployed reasonably large sums of capital. In terms of pharma, for example, we've increased exposure into the CDMO space, as well as the diagnostic space. That's the other area where we see some opportunities out there. And in the given the fact that the tech stocks have recently corrected in the last 6 months, we've kind of bolstered some of our exposure over there as well. So those would be the broader areas where we've kind of increased our allocation over the course of the last 6 months or so, with a 2-3 year kind of a view outlook as far as these sectors are concerned.
Hi, Harish. Good morning. Good to see you. When I recall the last time we chatted, you sounded very, very bullish, and that was good to hear. Given the kind of earnings estimates that are coming up, there are some geopolitical tensions as well. You don't know what Trump is going to do next. Do you still believe that you're as optimistic on the prospects for the Indian markets? And what about that Diwali? By Diwali, you said maybe we'll be singing a different tune, I think so. Do you maintain that by the end of this year, we'll be higher than what we are right now?
I mean, my comment was more from an earnings point of view that we will see a stronger second half compared to the first half. Of course, markets do discount a bit ahead of time, but we do remain positively biased towards equities at this point of time from a 2-3 year point of view. Yes, gains have been very fast and furious in the last 2 months or so. Possibly, currently we are not even discussing anymore what would happen to the tariffs, and when in July they come through, the 90-day window kind of comes off, how markets are going to react. If deals do get announced, how markets are going to react. So it could be a case of, selling the news at that point of time. So we would see some amount of consolidation and some kind of, correction in the markets possibly in the near term, because a lot of good things have got priced in very quickly. But having said that, continue to believe that earnings in the second half are going to be a lot better than what we've seen in the last 6-12 months, and which is setting up for a very interesting FY27 earnings print as well. So we continue to remain very positive from the earnings construct point of view, and believe that this is a market that needs to be bought on dips rather than sell on rise.
Yeah. I'm slightly pulling back to a macro question, and then we'll get micro again. I remember in one of the conversations, Harish, you'd said that currency risk in Asia, especially with the yuan, etc., perhaps is something that you'd watch out for. If you see today, as someone pointed out to me a while back, China has set its onshore reference rate at 7.1695. It's basic, and it's being the break of 7.17 is being seen as a bit of a symbolic knee-jerk appreciation. I mean, their stated goal has been a more smooth appreciation stance. Is the pressure building up for a one-step appreciation for the yuan? And it wouldn't be so bad, right, from an Indian perspective? I mean, it'd be worse if there is more depreciation. I mean, then you're essentially competing for export market share. But what about this one?
Right. So I think, the construct on currencies, at least from our understanding, has actually kind of changed quite significantly. So earlier, if we were worried, I think our focal point is where the dollar is going to be headed and stabilizing at. What the U.S. administration, and this has been well publicized by Stephen Miran and Scott Bessent as well, that they are looking at a weaker dollar. Now, this is a construct where we've seen the DXY cool off quite substantially, even as they've gone on with tariffs. And therefore, it is important to see where the dollar eventually settles at. That, I think, has got a greater bearing. So a lot of these moves of the yuan in terms of stabilizing, etc., possibly are also a function of where the dollar is going to be at. So I think there's been a change as far as a depreciation concern. For all you know, I think we are possibly headed into another regime as far as instead of a dollar weakness to get into a dollar strength. But of course, these are still very early times. I would think that in the next 3 to 6 months, we will get a better sense as to where the dollar eventually settles at.
You're saying that no, your view is the risk is dollar goes higher. That's what you're saying. Just to get that right.
So I'm saying that if earlier we had a view that, say, the rupee would go to 89, 90, and 95, and again, I'm not talking about the next 6 months. We're talking about a medium-term slope. At this point of time, there is an equal chance that the rupee can possibly going towards 80 and maybe even 75. I think this is something which is now a reasonable probability. Earlier, these probabilities may have been very small that actually the rupee may appreciate so sharply. Again, we are not talking about, just to be clear, we're not talking about the next 6 months or the next 12 months. We're talking about a medium-term direction. And I think given what we've seen as far as the dollar is concerned, the probability that the rupee actually appreciates has actually kind of gone up quite meaningfully in the last 3-4 months than what was the case before. So the view is that should the DXY, for example, go closer to 90 or maybe even 85 compared to going to closer to about 110. Again, these are macro views. There is never any certainty about any of these happening, but it's a scenario that we would like to kind of pencil in as far as our probabilities are concerned.
Okay, got that. Harish, just one last question on one specific sector from the financial space, insurance. Do you think there are enough sort of triggers lined up for both general and life insurers this year? I mean, in a way, as someone put it, could be perhaps the sleepy hit. I heard those bit of a exaggeration. Sounds like an exaggeration, but sector of the year, as someone called it. What's your sense, Harish?
We would welcome if such a thing happens. It's been a long winter, so to speak, of about 5 years, where insurers have been at the receiving end. There have been multiple flux of regulations that have kind of impeded value creation out there. But purely from a fundamental standpoint, 5 years back, there were many companies who wanted to take an insurance license, be it in general, be it in life. What we've seen in the last 5 years is that the bigger firms have actually become far more bigger in terms of their market shares, in terms of their combined ratios, in terms of their profitability metrics. Possibly there is nobody who wants to start a fresh insurance company or a fresh life or general insurance company, into the sector. Now, this typically sets for a very good case for value creation to emerge over the medium term. So we are positive on the space. We have reasonably large weights and large overweights on the sector. But when exactly they kind of move, possibly there is also likely to be a change in regulator out there. So we don't know what their stance is going to be. But this is something that we think that there is reasonable margin of safety after such a prolonged period of underperformance over the course of the last 3-5 years.
Okay. All right, Harish. Good conversation this morning. Thank you very much for joining in. We look forward to the next one soon enough. Thanks very much. You have a good day. Well, let's now move on to a CNBC-TV18 exclusive conversation. Malnutrition is a bigger problem than obesity in India, says Varun Berry, Executive Vice Chairman, Managing Director and CEO of Britannia Industries. In a conversation with Mangalam, he speaks about the demand trends, the growth outlook as well for the sector. Take a look.
India is a country where malnutrition is a bigger issue than obesity.
Yes.
Right? When you are at the bottom of the pyramid and you need bhook pyas is the most important thing, right? There's nothing wrong with our products, right?
Yes.
It's basically wheat, oil and sugar, right? Which are all basic nutrients, right? And it's the cheapest form of food. It's cheaper than any other food in the market, right? Now, you are an evolved consumer. You will have a different portfolio to choose from, right? Which will be much healthier. But we have to cater to the base of the pyramid. We cannot say that we will add some additional ingredients in this and we will take this price from, let's say, 10 to 20 rupees. That's going to be a price shock for the consumers, and we can't afford that.
Completely agree with you on that one. And that brings me to the base question of it all.
Yeah.
What does Britannia want to do now?
We want this company to perform consistently. Obviously, there are certain factors which have become more and more important with time. Making our portfolio healthier. I'm not saying healthy, I'm saying healthier. Making sure that we offer, different products to the base of the pyramid, but we bring in the right products for, people who are in SEC A and B. We want our portfolio to be enlarged. So our adjacency business, we are putting a lot of focus on. And I said earlier as well, the first stop is bakery with products which are in the adjacency space. And thereafter, we will see where else we want to go. Dairy is a big play for us. We've made very good progress with milkshakes and milk drinks. Not as much progress with cheese. Cheese has been growing, but small single digit. So we want that to move to the next level.
How do you define the next level? Because 2 years ago, I asked you, where do you see the adjacencies business? You said 3 years later it'll be 35%, 5 years later it'll be 40-45%, and 10 years later you'd imagine a scenario where it is 50%. So 2 years hence, it's still at 25%. So 1 year later, will it be 35%?
Well, I hope so. Not 1 year, but maybe 2 years. Maybe we are running behind our schedule. But 2 years later, certainly. But, it should not come at the cost of biscuits.
Yes.
That's the main criteria. Biscuits have to keep growing. This is our bread and butter. This has to grow aggressively, and that needs to grow 2 times this rate of growth.
It's interesting you say biscuits is your bread and butter, but the metric that you're tracking right now in the company, what would that be? Would that be revenue growth? Would that be volume growth? Would that be distribution reach? Or I read an interesting one in your earlier conference call as well. You said volume per outlet, VPO.
See, volume per outlet is very important, right? So we've got 2 clear, things that we measure. One is volume per outlet. Second is covering areas which we haven't covered till now. And there are many small villages which we don't get to directly. So we'll work at both ends.
Could you give us some quantifiable targets for that over the next couple of years?
So our distribution targets, we will, increase our distribution by at least 100,000 outlets every year.
Got it.
On an overall basis, our volume per outlet should remain stable, right? Despite going to much smaller towns and smaller villages, which means that the volume per outlet needs to increase in urban areas. In terms of the SKUs that we sell in urban areas, we sell about 9 SKUs per outlet. Right? Now that needs to go up by at least 10%. So that 9 needs to move to 10, right? Now what would that mean? That would mean that we are selling more categories, more SKUs into each outlet that we go to. So that's how we define our target.
Is margin an outcome of a lot of the things that you're doing? Should we look at it like that? Or are you targeting a margin and then back calculate all the rest?
No, nothing works without targets. So we have a target.
Which is what?
Well,
18 to 19%, what it is right now.
Well, we cannot give any forward-looking statement. We cannot give any forward-looking statement. The target always is to make progress on where you are at. And, as inflationary times get behind us, we will always be endeavoring to, move forward as far as margins are concerned. But I must say that we are in the top quartile of food company margins across the world.
There is the counter argument which goes like, India is such a beautiful growth market. Why worry about margins when you can keep increasing the top line? And there are companies, consumer companies, which have, not necessarily food companies, which have 25-30% margins, and they're not growing. So the street believes, what right do you have to have 25-30% margin when you're not investing in growth?
So that's a tightrope walk.
Exactly.
That's a tightrope walk, and you've got to do it really well, because I've seen a lot of companies go wrong there, right? And that's why I was talking to you about inflation, deflation, sine curve, etc. It's a tightrope walk. You got to make sure that you do not take the consumers for granted. You give them the product at the right price, and also keep an eye on competition and don't go completely out of whack. If you look at some of the companies which have gone wrong on that, you will realize that they just took their eye off the ball, and we do not want that to happen.
So your eye on the ball is maintain margins where they are with some improvement and continue to grow the core. At the same time, adjacencies grow at 2x.
Absolutely.
What does all of that mean in terms of numbers? Again, I ask you that because the last time we spoke, you said if I were to write a 5-year strategy note, of which we're 2 years into already, mid-teens growth would be a possibility. Obviously, a lot happened in the last 2 years for you to not realize that mid-teens growth. But do you think that is a possibility?
It's certainly a possibility. In a country like India, while we have seen a tough period, but once things come back, I think we'll be certainly in that zone, and not just us. A lot of our co-companies in the FMCG space, because that's where the country needs to be, right?
How far are we from that?
Well, I don't think we are very far. I think we are reasonably close to that, and I hope that that becomes the reality very, very soon.
And you can catch excerpts of that conversation all through the day on CNBC-TV18. All right, let's move on now. Time for an exclusive conversation. The shipping sector is facing concerns with respect to growing tensions in West Asia. So how does India stand? I mean, how severely exposed could we be to this? And of course, what is the way forward when it comes to development of waterways in the country, development of ports in the country? Let's talk about this and a lot more. We have with us Mr. T.K. Ramachandran, Secretary, Ministry of Ports, Shipping and Waterways, joining in for big picture perspective. So good morning. Thank you so much for joining in. It's a pleasure to have you on. So we want to start, of course, with the global developments to understand where we are. Now, it's a well-documented fact that 25 to 30% of the world's oil passes through the Strait of Hormuz. And as of now, it's operational. But, sir, what is it that you have been, reading, hearing and preparing for if there is wider disruption? We believe tanker rates have already started moving higher. If the strait is shut down, even for a couple of days or weeks, how can India ensure its energy security? What are the alternatives? I mean, storage. What are we looking at, really?
We have a series of options. Of course, much of this is what the Commerce Secretary or the Petroleum Ministry would look at. As far as shipping is concerned, our role is to ensure availability of vessels. Our role is to ensure availability of containers, ensure that the ports are up and running. And if there are alternative routes, then we explore those alternative routes. Luckily for us, we've had several of these so-called shocks over the last few years, starting with COVID, and then we had the Ukraine crisis, and then we had the Red Sea. So over a period of time, not only has the sector learned to become more resilient, we have also learned to live with the additional costs that might come with having to reroute the ships via the Cape of Good Hope and so on. So I don't think we expect much of a problem because of all this, though there will be some disruptions, also some minor increases in prices, insurance premiums and so on.
Mr. Ramachandran, good morning, sir, and really great to have you on the program with us. Just to take that point which my colleague Surabhi asked forward, I was reading that tanker rates, VLCCs, very large crude carriers from the Gulf to China, pre-conflict, they were at about 16,500. They've increased to about $48,000 now. So almost a 3x jump. Now, while a lot of the Iranian oil, bulk of the Iranian oil which goes to Asia goes to China, so that is separate, but we also get about 40% of our oil from that region. Not Iranian oil, but from that region. So obviously there are ships plying from that part to us. Have we also seen a big jump as the industry come to you?
Through that region.
Yeah, through that region. So have we seen a similar kind of jump? Anything you can tell us?
No, there are increase in rates, that much we have seen. And like I said, every time there is a disruption, there is a rerouting, and then there are increases in premium costs available. And because the rerouting happens, the availability of ships, that goes down, availability of containers goes down. So that leads to an increase in cost. And generally the industry has absorbed it. The market has absorbed it. So we haven't found that this has caused disruption in the supply chain. It manages itself somehow. Yeah.
So just one more point. This is something you had alluded to, so again, just going back to it. The rise in insurance costs. And that's already happening. I mean, if I look at some of the international sources, what they're saying is that insurers are now charging apparently 0.2% of the value of the ship. This is just in the last 2 weeks, 7-8 days since the conflict broke out, versus the earlier practice of maybe 0.125% of the value of the vessel in terms of insurance. If costs keep spiking, because there are a lot of these geopolitical conflicts all across, and, the Houthi threat, etc., I mean, is the government of India prepared to sort of support industry in any form? Has industry sort of expressed any concern on this? What happens?
At least so far in the shipping sector, we haven't heard from the industry, and they haven't really come forward with any specific demands. So as and when they come up with some specific demand, we will look at them and take appropriate steps as necessary.
Got that. Mr. Ramachandran, all this sort of upheaval around the world throws up, of course, is, as in most sectors, maybe, to reduce dependency, right? Now, in the case of shipping, especially cargo shipping, we rely, I think, almost 90% on foreign vessels. Is the government taking any concrete steps to boost Indian flagged fleet and reduce this dependence?
Yes, so see, there are some short-term measures that we need to take, obviously, which have to then be constrained by the fact of availability of ships. Then there are some medium and long-term measures that can be taken, and of course, you might have heard that in the recent budget that was announced in January of this year, there have been at least 3 measures which have been delineated. One of them has to do with increasing all of them basically have to do with increasing the tonnage, Indian tonnage, so that more ships are available, more ships are flagged in India, and more ships are built in India. And you're quite right, almost 90% of our cargo at the moment is carried by foreign flags. Therefore, there is a very urgent need to be able to use Indian flag ships to move our cargo, and therefore the government's 3 major measures. One was the upgradation of the existing shipbuilding financial assistance policy, so that more ships are built in India, And if they are built in India, they are usually also flagged in India, which means our tonnage increases. The second scheme is for increasing the availability of finance for the industry. As you're aware, the shipping industry was not classified as infrastructure, in the harmonized master list. Now it has been announced in the budget that it will be classified, it will be part of the HML. Therefore, they have access to better tenures, longer tenures, and lower interest rates, which means the industry gains and ships can be built, etc. in India, also owned. More of ownership can happen because you have access to funds which are at lower cost. And the Maritime Development Fund, the creation of this fund which gives equity support to ownership of ships in India, I think again at 25,000 crores is going to be a big boost to the shipping industries, the size of the shipping industry. And I think basically because of the Maritime Development Fund, we expect a lot of investments to flow in. And over the long term, of course, we expect that in the medium term, the ownership of ships will increase. In the long term, building of ships will increase. So these are things that we are expecting. And finally, there is a capability and capacity building pillar, the third announcement that was there in the budget. And in this, we are hoping to increase the capacities of the existing shipyards in the country, as well as open and launch new shipyards, at least 2 to 3 greenfield shipyards, which will have huge capacities, and we will be able to build our own VLCCs and VLGCs, which we are not able to at the moment. So there is a lot of work going on all these areas, and I hope that the next time we have a crisis, we will be, really well prepared.
Yeah. Mr. Ramachandran, just a quick word, sir. How many ships as an industry do we make in India right now? And what's the ambition really? Globally, for example, US is talking about really building up their shipbuilding. I think they've been building a few less than 5 ships a year. China builds hundreds of them every year. It's by far the largest shipbuilder country. Could you give us the Indian context? Where are we now? What's the ambition?
Yeah, so it has been very bad. Of course, we have moved. We were at 0.01 or something like that, and then we moved to 0.04 and now 0.08 million tons GT per annum. So which means we are at less than 1% of the world's shipbuilding output. So that is where we stand. And 3 countries, China at 60+%, Korea and Japan. These are the top 3 countries. Between them, they manufacture or build about 85% of the world's ships, which means we have a lot of catching up to do. Even if we are able to build about 500 or 600,000 GT tonnage reach that mark, we will be reaching the 5th or 6th position in the world. So the Maritime Amritkal vision, which was launched by the Honorable Prime Minister in 2023, has set a very clear vision for the country in terms of what we want to achieve by 2030 and where we want to be in 2047. So we want to reach the 10th position in the world by 2030 and the 5th position in 2047, which means we are looking at a CAGR of something like 8 to 9% if we just want to retain or slightly go ahead in terms of how much of our cargo we are able to carry. But if we want to carry 20% of our cargo, we have to grow at a CAGR of not less than 17-18%. So this is what we are aiming at, and we hope to be able to touch about 6 or 7 lakh GT per annum. It's about 10 times what we are doing, or 10 or 20 times what we are doing now in the next 5 years. That is how we are looking at it.
Okay, very, very interesting. So that's how the math and the numbers stack up if we are to build Atmanirbharta when it comes to our fleet as well. So that's about ships. I want to also get your view on ports and what's the big picture there, because according to some industry estimates, when there's a broker Motilal Oswal, their estimates say that the Indian port sector should grow at a steady clip of 4 to 7%, so mid-single digits basically, over the next several years in terms of how much cargo is being handled, what is the growth like. Do you agree with that assessment? Would you be satisfied with that rate of growth? And then, what happens? Because we are in a world where supply chains are shifting dramatically. Trade patterns, trade routes, trade alliances are shifting, rapidly. So how can the Indian port sector ensure that it takes advantage? We, of course, have projects like Vadhavan, and long time, but I think it's 5 years into completion, so it's a while away. But what do the next 2-3 years bring for the Indian port sector?
Like you just mentioned, see, we had a capacity of about 1,600 million tons about 10 years back. Now we are at 2,600 million tons in terms of capacity. We, the major ports, for instance, did about 500 plus tonnage, million tons 10 years back. Now they do about 850. And overall, it's about 1,500. So the major ports, which is the government-owned ports, the central government-owned ports, and the non-major, and we don't call them non-major any longer because some of them are bigger than the so-called small major ports. For instance, Mundra, Pipavav, and so on. So the other than major ports is a term that I'd like to use, and which we now are tending more to use. So the other than major ports actually do about 45%. We do about 55%. So there is a lot of growth, as you can see. It's about 1.7x what was there 10 years back. This growth is attributed entirely to the ports investing in additional capacities and also to PPPs. Every port, the major port, has gone in for PPPs, and the capacity building is happening in partnership with the private sector also. And like you said, one port, Vadhavan port alone, will double our container handling capacity from 22 million tons per annum to about 45 million tons. So they add about 23 million tons. And also, the overall tonnage will be about 300 million. So it will be one of the biggest ports, not just in India, because now we have ports which do 150 million tons or 180 million tons. But one of the biggest ports in the world, which will handle about 300 million tons, will be the Vadhavan port. Then, of course, there is Galathea and so on. So our aim is to ensure that every single state does a master plan for the entire coast which falls within their state and identifies places where ports can be built or expanded and upgraded, so that we have this master plan ready within the next few months. Therefore, we will be able to concentrate on certain projects which are of critical importance, strategic importance, and by 2047 we want to be at 10,000 million tons per annum. It will be one of the biggest shipping port capacities in the world. 10,000 million tons per annum is what we are expecting to reach in 2047.
Sir, just one question with regards to ports. If you look at the total port capacity, however you want to define it, within operated by the government and operated by the private sector, if you have those numbers ready, and every year, how much of it will you how much will be opened up to the private sector? Because that is the big hope for. We speak with listed port operators as well. Any guidance you can give us?
Yeah, I mean, we have a huge number of private PPP projects happening now. I think at last count it was about 81, and about 54,000 crores worth of PPP projects, being either underway or have been completed. I think about 34 or 35 have been completed in the last few years. And our aim is that 60%, at the moment we are handling almost 60% of our cargo through the private operators, which might be news to you. In JNPA, 100% of the cargo is handled by private operators.
Yeah.
So this jump which we have been, and it was only 30% a few years back. So this growth is happening because of the private sector involvement and the PPPs. And as you know, 30 years back, it was the shipping sector, the port sector, which first went in for PPPs, Mumbai and other places. Therefore, the port sector has a lead over many other sectors as far as PPPs are concerned. And it is our conscious attempt to ensure that we have better efficiencies, better ease of doing business, and of course, we bring in investment from the private sector and the speed of execution. So all these advantages we are seeing, and we hope to work on that and build on that.
No, very good sort of guidance and sort of insights there. Just one last question. I mean, it's such a vast sector, waterways. And the government, as the Prime Minister said it, I mean, we've heard it from you earlier, we've heard it from the general thrust, right? Developing waterways, which is one of the cheapest modes of transportation, moving goods and people as well. I mean, on a lighter note here in Mumbai, for example, we've been waiting for this Mumbai-Goa connectivity.
Or even within Mumbai, if I could add. I'm glad you brought that up, Prashant. I mean, the ferry service, and I mean, there's so much chatter around it, on, off.
Yeah,
We want to know as Mumbaikars.
It is right there. I mean, the potential is there. And will we see quicker development, sir, on these projects?
Absolutely. In fact, I can go on and on about the waterways and the works that are happening. But just to keep it short, you see, we had 5 waterways 10 years back, national waterways. Now we are at 111, and about 29 of them are operational. This is in Mumbai, this is in Goa, Cochin, Kerala, Orissa, West Bengal, of course, Ganga and Brahmaputra and so on, Orissa. A lot of these waterways need to have water in order to have the ships moving or the vessels moving. So the first attempt has been to ensure that we dredge these fairways, they are called, creating and maintaining fairways. So dredging the national waterways and ensuring there is adequate depth, adequate water, so that the vessels can move, that is our first priority, and which is happening, already happened on the Ganga. We are now able to assure what is called the least assured depth. And it's like a chicken egg. Unless you have the depth ready, you cannot get the vessel moving. And the vessel will not come in unless you have the depth available. And if you have the depth available, you have to wait till the vessel becomes available. So this chicken egg situation is what we are trying to get out of. Then you require terminals which can handle the cargo and also ensure last mile connectivity. Luckily for us, we've built terminals, for instance, on the Ganga, on the Brahmaputra, at several other places. The terminals have been built. So again, then we require vessels to move on these fairways. So again, vessels, we have invested in vessels. We have several vessels being bought as well as deployed on the Ganga, Brahmaputra, for instance. Many private operators have moved them. As you know, the cruise operators, for instance, there are more than a dozen of them moving along the Ganga, and some of the most successful movements are the cruise vessel movements, the river cruise.
Right.
Just for your information, one of the longest cruises in the world, river cruises in the world, the Ganga Vilas, it has moved 3,500 kilometers from Varanasi to Guwahati and Dibrugarh beyond. So this kind of river cruise is booked till 28, and all foreign tourists, cruise tourists. So this is the kind of thing that is possible if you develop this sector. But like I said, infrastructure, vessels, and of course terminals, and ensuring. And we have a scheme for cargo, which is called the Jalwahak scheme, which gives a 35% discount to all cargo which is more than transits over 300 kilometers or more. And
so very quickly,
we have several projects for transit and all that.
Yeah, so very quickly, sorry to cut in because we're out of time. We've hit 10 o'clock. But very quickly, the coastal transportation, transportation of people. Any new plans afoot on that? Whether it is within coastal cities like Mumbai, whether it's Goa. Anything more on people transportation via the coastal routes?
That is the point I was coming to. That finally the integration between coastal and riverine movement. That is very crucial, because many vessels which can be used along the coast can also be used on the river, in the rivers. And therefore, if we integrate, we have seen that there is much more of synergy to be obtained, and the movements become more flexible, and we are able to generate more efficiencies. So that integration is what we are looking at.
Such a great conversation, and so much perspective and insight across your domain, sir. Thank you very much for coming on and patiently taking us through all of that and developing all of this. Of course, such a critical part of the move towards the overall development of the country. Waterways, of course, very, very crucial. Thank you very much once again, sir, for being here on CNBC-TV18.
Thank you so much. Thank you so much.
All right, so that's the shipping polls, waterways sort of entire perspective coming through. 70 points higher, 24,864. By the way, Surabhi, I know what you were looking for specificity. We wanted to hop on a boat and Bandra and get too early.
Anything that speeds up movement in the city of Mumbai.
Okay, all right. Nagaraj Sethi is with us with technical trades, and what he'd like you to do is with HDFC Securities. Nagaraj, morning. 75 points, so it's a much better day compared to the last four. What are your trades?
Hi, good morning, Prashant. Yes, rightly said. Showing some signs of recovery from the lower support. There is a support for around 24,700 levels, and the overall market trend has been a choppy. At the higher levels, market is facing a severe resistance at the lower level, showing some supports. So far now, around 24,700 is going to be a support. Once Nifty moves above the hurdle of around 25,000 level, that is going to be an initial sign of strength in the market, and that could propel the market to another 200 to 300 points higher once it moves above this 25,000 levels. At the same time, the range bound action is likely to continue, and if it slips below the support of 24,700 levels and more weakness towards the next support of 24,500 is going to be there for the Nifty for the short term. That is a setup, and in this setup, I have two stocks, as you mentioned, from the mixed side. One is from long and one is from short. And technically, the long is the Indus Tower. Chartically, if you look at the Indus Tower, has been in a consolidation phase. It was in fact outperforming during volatile broader markets. And today, it has broken above the range and moved above the important hurdle. Currently trading around 397.98 levels. One can look to buy at this point of time. Initial target would be around 425. One can place a stop loss at 382. And second one is from a short side. Metal sector itself is showing some weakness. And if you look at the Hindustan Copper, that is showing some distribution type of pattern after a decent upside bounces around 265, 270 levels. It has declined in a couple of sessions and it has currently moving below the 200-day EMA. I think overall chart pattern is looking weak. If it comes down, one can look to sell at this point of time, and the target would be around 232, 33 for the initial target, and one can place a stop loss at around 261.
Okay, all right. Interesting trades, and thank you very much for those, Nagaraj. Appreciate it very much. We take a quick commercial break here. Manisha Gupta with commodities on the other side. Stay tuned.
Welcome back. So the equity market continues to have a good Friday morning, still up almost 100 points on the Nifty. Let's now find out what's happening in the world of commodities, where at least in the crude markets, things are still very, very nervous and edgy. Let's go back to Manisha for the latest. Manisha, over to you.
Well, thank you for that. Yes, when you look at the crude oil prices, we've seen 3% of gains in the overnight markets. It's headed for a third weekly gain into there. And then there are supports coming in from the geopolitical premium. And the markets also have seen various statements being coming out. Israel, for one, says that they are intensifying their attacks against Iran. Also, there doesn't seem to be any sign of an exit strategy coming in from either side. That is keeping the crude oil prices in good favor. But the oil rally has hit some breaks in the Asian markets right now. We are trading nearly a percentage point on the lower side. That is after Trump says that he will take a call on striking Iran in 2 weeks from now. So that adds to the uncertainty, and the markets also have gone in a bit of a profit taking in Asia because of that statement that came in last evening. Also, the prices are capped by the fact that you're looking at higher supply expectations for the second half of this year and in 2026 going forward as well. Whether it is about OPEC supplies, non-OPEC supplies, you are looking at that increasing, and that is the reason production elsewhere has offset the disruption impact that the markets believe could come in from the western part of Asia. What the brokerages are saying is quite important, and they have been reiterating, changing, revising their crude outlook in sense of prices going forward. I'll start with Citi, which says that the prices could hit 78 a barrel. We're not too far away from there. if the conflict disrupts 1.1 million barrels per day, that is of Iran exports. Iran as of now is exporting 1.1. But Citi also says that disruption of 3 million barrels per day could lead to prices going to $90 a barrel. They still don't believe that the prices can go to a triple digit there. So that is their worst case scenario on the higher side when it comes to crude there. JP Morgan says in an extreme scenario, if there is a closure of Strait of Hormuz, that is the only time that you will see the prices breaking triple digit and going up to $120, even $130 a barrel on the higher side. Goldman Sachs, in the meanwhile, says that the geopolitical premium already into the prices, and $10 of a war premium is what they're looking at. Once this de-escalates, you could be looking at the prices coming down yet again. Interesting report also coming in from Barclays, which says that prices can go all the way to 85 if Iran exports are cut by just about 50%. Remember, Iran is exporting 1.1 million. So half of that also, if it goes down, then the prices can go to 85. Mizuho Group, we spoke to them recently on the channel, and they said that the prices can actually look at a very big range here. $85 a barrel is their bet if there is disruption to the Iranian exports. So there are lots of ifs and buts, and the markets do not seem to be moving unless there is an actual disruption in supplies, in exports as well. But Mizuho also says that de-escalation of tensions can bring the prices down to $65 a barrel in a jiffy as well. Trading.com also has a similar range, 65 to 85, depending on what kind of a scenario do we work with. And Bank of America has actually put a long-term range as well, given the fact that you're looking at higher supplies going forward. Bank of America says that until 2030, they're looking at the prices ranging between $60 to $80. For this year, their average stands at 75 at this point in time.
All right, Manisha, thank you very much for that. So that's oil very much in focus, top of mind really from a financial market perspective. Okay, I think just a quick 30-second check as far as markets are concerned. We're up 90 points at this stage. I think volumes are still lagging, so volumes aren't very high at all, and that's been the case for the last few sessions. And I was saying this earlier, it's just something that I picked up, of course, no confirmation, that big players in the derivative market, like the Janes of the world, the Jump, the Citadels, I mean, their activity has been a little on the lower side the last few trading sessions. There's been a fair bit of attention and focus around it, focus around these players and their role in markets every day and the volatility that we've been seeing. So we'll try and confirm it, but that's just chatter that I picked up. 90 points higher, 24,890 is where we are at. Okay, we'll take a quick commercial break here. It's our special segment. It's the economy. Lata in conversation with Neelkanth Mishra of Axis Bank on India's macros and markets. Stay tuned.